Well, good afternoon to everyone, and welcome to the January Crop and Livestock Outlook brought to you by MU Extension, the Ag Business and Policy Division, and the Food and Ag Policy Research Institute. Today, we're going to talk about a couple of things. One is, first off, to get started, just some special issues, and of course, tomorrow we have a big announcement or news, at least about the Phase One trade agreement. Hopefully, some details there on that. We'll also be covering the corn and wheat outlook. Marty Foreman's going to take us through that. The soybean outlook, I'll cover that quickly. And then Dave's going to take us through the technical analysis of where some of the prices are moving. And then finally, we're going to wrap up with the livestock outlook by Wesley Tucker. And we invite you to ask questions. We're going to try to leave some time for that, but we do have a few slides. So we'll warn you early on that we might be a little bit long on this one. So I'm going to jump right into some special topics. First of all, I wanted to remind everyone we're about midway through the farm program decision support meetings. I know some were just held last night over in Mexico, and you can see our schedule here for the rest of January and into February. And so that way, if you want to attend one of those and it works out, they give you an idea of where those are. One of the things I do keep wanting to mention to everyone is to remind you to get signed up by the 15th of March, because right now they haven't extended that deadline, and we're not sure if they will. But if you don't get signed up by the 15th, you won't get a 2019 payment. And while you're in there, you might as well go ahead and sign up for 2020, because you can't actually change your decision from 19 to 20. So whatever programs you sign up for, ARC, PLC, ARC, IC, you will be signed up both for 2019 and 2020. So don't forget about that. The other thing I wanted to mention was our grain marketing workshops, which we're going to launch February 17th. We hope, if you're interested in this area, that you'll come to one of the workshops. They're designed to be about 4 hours, but remember that includes lunch and a couple breaks, so it's really not 4 hours. And we hope that you would find it useful in developing a marketing plan and show you some of the unique things that we have for the state of Missouri. With that, I'm going to jump right into special topics. One of the things that we've been talking about for the last several sessions is the African swine fever, and really what we're wondering is how quickly the Chinese herd can recover. This is the official announcements from China that came out 4th of December. And you can see on there that they are expecting that they have turned the corner and that they should not have any further declines in inventories. They've got protocols in place to help control the spread of the disease, and they've been, actually stopping people that were transporting animals in vehicles, cars, trucks, all sorts of things, and trying to really slow down the spread of the disease and effectively stop it. It does look like they've had some success. Their breeding sow inventories are up for the second month in a row, and their pig herd is reported to be up 14% month over month. So the other positive sign for them is that their pork prices are starting to fall within China, because they have been very, very high. And of course, naturally, at this time of year, it's a very high demand time because of the Chinese New Year. So they're looking to make a full recovery in their production by the end of 2020. That's a pretty aggressive goal. And, if there's anything left over, they expect to be back at average production levels by the end of 2020. And if there's anything else in terms of expansion or continued expansion in herd, they expect that to happen by 2021. So in some ways, it's good news for the soybean sector, as this may result in a quick resurgence of demand for soybean meal. But I think we still have some opportunities here for pork exports to China. So don't write those off. I do think we're still going to see some activity on that side. Okay, so tomorrow is the big day in terms of when we should know more about the U.S.-China Phase 1 trade deal. I just pulled out the implications for ag here. Of course, there's lots of other things in that, but you know, right now the deal is that China is expected to increase purchases of U.S. ag products by $32 billion over 2 years. So that's roughly $16 billion a year. Above the 2017 levels prior to the trade war. So in 2017, the Chinese bought $24 billion worth of ag products from the U.S. If you add $16 billion to that, that's what gets you to the $40 billion per year. Now, they have also been pushed to go to $50 billion per year. Now, the Chinese have responded to this by saying, yeah, we'll try to get another 5 billion on top of the 40 and get close to 50 billion. So, you know, to me, that looks like 45 billion, but I'm not sure. Maybe it rounds up. And then you see at the bottom there that China also has committed to reducing some non-tariff barriers on some of the biotech products, poultry, seafood, and feed additives. So, but there's a lot of really uncertainty about what the details are of the agreement. You know, we don't even know if the $24 billion is based on the U.S. Department of Commerce data, or is it a Chinese source, or exactly how was that level benchmarked in 2017? You know, so is it, you know, it could be a value at the border, at the Chinese border, which would then include shipping costs and other things. Does it have tariffs in it, not have tariffs in it? Those types of questions, you know, and then even the detail of which products, you know, are there specific commitments for certain types of products? You know, does corn have a specific commitment and soybeans have a specific commitment, or are they just sort of grouped as a category? Which then makes it a little bit more challenging to kind of keep an eye on what do we need to monitor to ensure compliance. So you can see there's lots of details in here that would still need to be worked out. I did put together a table for you so you could see if we just use the U.S. Department of Commerce data for 2017, what does this look like in terms of what they bought from the U.S. And you can see 51% of the ag and ag-related products was soybeans in 2017 at $12.2 billion. And you can, you know, as you look through there and you think about some of these categories, where might there be opportunities to add another $16 billion in sales? I certainly don't think soybeans is going to get it all, but they might get a substantial chunk. There's possibilities of taking wheat and corn up to TRQ levels, which might, you know, again, give those categories a bump. There's also opportunities if you look at some of the intermediate products and the consumer-oriented products. The pork side certainly could be a big one. Dairy might find some additional expansion in market. Fruits and vegetables, depending upon, you know, the perishability and the feasibility of shipping that many more of those products. And certainly if we picked on the ag-related products, there may be an opportunity for ethanol in this agreement. So a lot's going to depend on how many details we get tomorrow. We still may or may not know everything we'd like to about where that trade agreement's going. So with that, I'm going to pass it back to Marty, and we'll go from there.
Thanks, John. Well, I wanted to walk through some of the headlines of the report last week. So first of all, USDA did some revisions all the way back to 2018 crop. So they revised the 2018 crop a little bit lower and then raised the feed use on the demand side for 2018-19. We'll go through some of that in a minute. And for 2019, they raised the yield and lowered the acreage and netted a small increase in production. On the demand side, they revised exports down again. It seems like that's a pretty consistent theme that we've seen in the corn. WASDE updates is continued revisions down in exports. Mostly, though, offsetting changes to 2019-20 supply and demand, and resulting in little change in the ending stocks projection. And then there was no change in the South American production estimates. Just to start with acreage, so you can see here that we've got current planted acres for corn is for 2019 wound up at 89.7 million. I guess just to kind of review, back in March in planting intentions were 92.8. And then the acreage report in June came out at 91.7. And so pretty significant downward revisions in planted acres for corn. Although that 89.7 is probably a little higher than what people were thinking, as we were going through a lot of those flooding issues in the spring, with some folks talking about maybe as low as 87 or maybe even 85 million acres. So to some extent, we wound up with, I think, a little higher acres than we maybe thought we would back in the spring. And then for 2020, it looks like we're set for almost by default an increase in plantings next year. Our projection is at 92.5 million acres, so up from 89.7, almost a 3 million acre increase. So here's the balance sheet. The acres numbers there at the top, that's revised to planted acres and harvested acres at 81.5. We wound up with the yield actually increasing a bushel to 168. Now, ahead of the report, the trade was really expecting the yield to come down about a bushel or so rather than an increase. So that was a little bit of a surprise to see the yield increase. We also, moving on down there to the beginning stocks, with the changes on the 2018 crop, mostly due to a pretty big downward revision feed and residual for that 2018-19 column. We wound up with larger carryover from last year. So beginning stocks this year edged up from the previous forecast. And now we got production at essentially 13.7 billion bushels. With a total supply up to 15, pretty close to 16 billion bushels. I guess on the demand side, the big change here was really the feed and residual. They made a 250 million bushel increase in the feed and residual. We'll talk a little bit more about that in a minute. So a pretty large increase there, and that kind of helped offset some of the other changes on the supply side. Food, seed, and industrial, they lowered that to 20 million, and then again down there at exports, that was revised down about 75 million from last month. And so we wound up with ending stocks just a little below 1.9 billion this year, and they had no change in the price forecast at 385. So you can see they're moving over there to the 2021 column. We've got area planted expected at 92.5 million. We see a rebound in the yield back to trend line, sort of yield at 176 fraction. We wind up with a crop pushing close to 15 billion bushels. With a recovery in use, particularly on exports, we still wind up though with ending stocks next year, climbing up to a little over 2.1 billion. That would put a little bit of pressure on prices, with the season average down to around 370. December 1 stock. So in addition to revisions in production, USDA issues a quarterly stocks estimate. This one is the December 1 stocks estimate. It came in at 11.389 billion bushels. That's down 548 million from a year ago. So slightly tighter stock. So despite the fact that USDA raised the production estimate a little bit, actually the stocks number came in a little below where the trade was expecting. The trade was expecting USDA to cut production and then stocks to come in around 11.5 billion. This came in well below that. So what this is really implying is that the feed and residual use for that first quarter of the marketing year, September to November, was quite a bit higher than expected. We'll talk about that in a second here on the next slide or two. I guess the other takeaway from this is on-farm stocks versus off-farm stocks. The on-farm is 63% of that total. And that's fairly close to the long-term average. About 20-year average is close to 62%. So just a slightly higher, proportionally, slightly higher on-farm versus off-farm stocks. So this goes to the feed and residual, what's implied by that stocks number. You can see there the red line is the percent of implied feed and residual for the first quarter of the marketing year, so September through November. And that's represents 47% of what USDA is forecasting for the marketing year. So nearly half of all the feed and residual use for the marketing year is kind of piled up into that first quarter. And then sort of the nominal number there is right around 2.6 billion for that quarter. You see, that's way higher than we've been all the way back into the 90s. So, I guess a couple of things from this, I would say, either, the feed and residual number, is at risk of increasing down the road, or perhaps, maybe the 2019 crop is still possibly overstated. One thing I should mention too is that USDA indicated they're going to, since there's still a lot of corn left in the field, in the northern plains and the Dakotas, Minnesota, Wisconsin, they're going to do some resurveying here later this spring. So there could still be some further adjustments to the 2019 production, based on, how that corn that's still in the field, lines up. And that would also could impact the stocks numbers. Now, I don't expect USDA to make any revisions to the feed and residual till we get to the next stocks report, as of March 1. But that's, I guess, something to kind of keep our eye on is potentially further revisions to production and possibly the stocks. But this is probably, I guess, the biggest surprises of the report is just how strong implied feed and residual use was in that first quarter. Exports are still tracking well below recent years' pace. If we look at the exports for the projected for the marketing year, down at 1775. So we're down. If we went back all the way to May WASDE, May 2019 WASDE, this export projection has been revised down 500 million bushels since then. So that's made a pretty big difference in how the balance sheet on corn shaped up because of the much weaker exports. And if you kind of look down through the list of countries, it's pretty widespread. We got a big decline in exports to Japan, Taiwan, Korea, Saudi Arabia, African countries, as well as Mexico. So it's kind of across the board in terms of sales to a lot of the larger customers. I put this slide in. This is out of the briefing to the Secretary of Ag from USDA. I thought this was at least interesting to show, what's going on in South America in terms of, where a lot of the second crop corn is grown. So you can see the green there. Mato Grosso, Goiás, those states are the large growing states in Brazil. You can see 71 million metric tons. So, from 70 to 75% of the crop in Brazil now is this safrinha crop, which is just starting to be planted now. So that crop will be harvested in June, July. So most of the big end of the crop in Brazil, that planting is just beginning. So we have essentially that entire growing season ahead of us down there. So that'll be a big market factor as we move through the winter and on into the spring. I've got the graph here on the forward curve, or this is just plotting the futures prices, and that yellow line there is the January. This is as of the closes last Friday. And just plotting, say, the March, May, July, September, December, and then the March 2021 futures contract. This shows you the level of carrying charge in the market. You can see that prices just across the board bumped up from when we were doing this webinar last month. At that time, prices were kind of near the early winter low, and we've rebounded, 12, 13, 14, 15 cents from then, but still maintaining a decent amount of carry in the futures market. Also on the cash market side, this is just plotting the basis. So down in there in the boot heel, along the river, you can see the basis levels are still tracking there on the far left-hand side of the graph. Those red dots, you can see we're still above the 3-year average and above a year ago. So basis levels on the river are still pretty decent. Same kind of thing if we look at Kansas City corn basis. There on the left, you can see we've been tracking well above the 3-year average all through the second half of last year, and then starting this calendar year, we're well above a year ago in the average. If we look at March futures, futures prices have been kind of in a trading range. We broke, I think, down through the downtrend there, earlier this winter, and then prices have kind of stalled out around at the high there in the low 390s. And then we had the report come out last Friday. You can see on the far right there that kind of wide swinging day where we had initially, when the report came out, prices were down, and then we kind of recovered slowly through the day and wound up closing a little bit higher. So I think that, I guess, the good news from that is just the fact that on balance, the report, I think, was a little bit negative given the production estimates, but prices managed to kind of hold on and actually close a little bit higher. So anytime you see market respond positively to generally negative news, that's a good sign. Looking at this chart, and Dave can go into some of this in more detail, but I think if we can see the March futures push out over that sort of low 390s, 392, 393, then probably sets us up for a move up to that 4 to 410 range here over the near term. Now, if we're looking at the December futures contract, you can see we had a kind of a reversal higher day last Friday, following the reports. And so again, that looks like it's in pretty decent shape for possibly move out over that most recent high at 405. And again, if you can clear that, sets the stage for something up around 410. So in terms of the price outlook for corn, we've got above average basis levels. So that's something to keep your eye on. I know one thing that they were talking about in the trade is that some of the quality of the crop is off a little bit. Might be struggling to get good quality corn, especially into some of these export channels. So I think that may be one of the factors contributing to the stronger basis. We've had that favorable price response, at least so far, to the January reports. Offsetting that to some extent is weak export demand. Probably a little bit of optimism, though, as John pointed out, though, with China. So if China does step in and start buying some corn, we could get some positive response out of that. And so maybe we've seen the end of these downward revisions in exports, if that were to be the case. We still have most of Brazil's growing season ahead of us, so we'll have to see how the weather unfolds down there. Generally speaking, though, if we have near-term price gains, I think I would view that as a possible selling opportunity, or the old adage in the commodities market, buy the rumor, sell the fact. So I think we've probably built in a little bit of premium, a little bit of optimism over, the situation with China. So we'll see, what the announcement says, and see how China responds. If we get some follow through on that in price wise to the upside here, I think I would be looking at a possible selling opportunity for probably both old and new crop. With normal yields in 2020, though, it looks like we're headed for a stocks increase. So longer term, barring some weather issues, either in Brazil, Argentina, or here in the U.S. later this year, I think we're probably looking at kind of a defensive posture in terms of price outlook going into the spring. So I'll shift gears and talk about wheat for a few minutes here. I wanted to, as part of the reports that came out last week, USDA issues the winter wheat seedings report, and so winter wheat seedings were down a little bit to 30.8 million acres, and that's the second lowest winter wheat seedings on record all the way back to 1909, as far as they've got statistics for it. So overall, winter wheat seedings were down. However, soft red wheat, the SRW acres, the kind of wheat we're growing here in Missouri, were actually up 8% year over year to 5.64 million acres. So a little higher soft red acres overall, but still, we're kind of in this long-term downtrend in wheat acres and in winter wheat seedings as well. If you take a look at Missouri winter wheat acres, even though all soft SRW acres were higher, the plantings here in Missouri were actually down 20%. So that's down to 440,000 acres, which is the second lowest on record. Record low was 340,000 back in 2010. So we're still at the very low end of the range on winter wheat seedings. I think the weather issues with the row crops here and the late harvest, I'm sure, contributed to a lot of this lower acreage in Missouri. Wheat stocks were down a little bit from a year ago. Let's see the number. Yeah, so the stocks number was 1.834 billion bushels. That's down 176 million, or down almost 9% year over year, and actually came in about 80 million bushels or so below where the trade estimates were. So a little bit of tightening of wheat stocks. Looking at the balance sheet, USDA doesn't make any changes typically to the production estimates for wheat. Those are finalized earlier. So with the crop at a little over 1.9 billion, beginning stocks about 1.1, wind up a total supply at about 3.1. So no change on the supply side. On the demand, really the big change was with feed and residual. With a little tighter D1 stocks, it implied that feed and residual use was a little better than expected. So the feed and residual number went from 140 up to 150 this month. So a little bit of improvement there. And that all fell on down through the balance sheet with stocks tightening to 965 million. Now, if you turn to the 2021 column, expecting acres just to be flat to just fractionally higher next year. Yields down a little bit from a fairly strong number this past year. So you wind up with a little lower production at a little over 1.8 billion. Food and seed rebounds a little bit. However, feed use is down, and then exports are forecast down. So we still wind up with a pretty healthy carryover at just a little under 900 million bushels. One thing I wanted to point out, I talked a little bit about this last time, but this is a pretty odd situation in that we've got the, typically, you see the Kansas City wheat trading at premiums for, a long time. This graph goes back to 2010, but you go back even further in time than this. And, typically, your Kansas City wheat's trading at a premium to the Chicago market. The higher protein wheat and red wheat tend to command a premium. However, over the last, several months, last year, particularly through most of 2019, we've seen this situation reverse, where you've got the Kansas City market trading at a discount to the Chicago market, which is pretty unusual. Not a lot of good explanations for this that I've been able to find. To some extent, they're kind of blaming this on the fact that with the increase in Russian wheat exports, that maybe that's displacing the hard red wheat here in terms of export demand. So, this is something to keep our eye on. To some extent, I think, though, you have to see this as a little bit of an anchor on what the potential is for the Chicago wheat market. I guess the other thing I'd point out too on that is the fact that we also have Chicago wheat trading at a pretty big premium to the corn. It's up around $1.80 a bushel. I mean, it's not the widest ever or anything, but that's a pretty healthy premium. So I think if wheat prices are going to go much higher from here, it's going to have to be helped by the corn market, because I don't think that spread's probably going to stretch a whole lot further. This is looking at the nearby wheat futures in Chicago. See, we're kind of at the upper end of the range going back a few years. So, pushing, between this $5.60 to sort of $6 range up there is a resistance level. So if we get a little follow through up toward that high back last summer on the nearby contract, I think that looks like a pretty decent spot to do some selling. Taking a look at the July, right now, in fact, as we speak, this July futures contract's pressing up against those previous highs right there around 570. So we'll see how it behaves here, but there may be an opportunity on new crop wheat to do some pre-harvest type selling, because I think we're up against a pretty significant resistance point on that chart. And with some of the other things I talked about, with stocks likely to at least stay fairly high next year. And seasonally, we've had a pretty good run in this market. You can see, you go back to September at 470. Now we're up at 570, and we've put $1 a bushel in the wheat price on the futures side. That's a pretty healthy rally. And so anytime you see a market and make a move like that, you're probably best to reward it with some sales. So with that, I'm going to turn it over to John to talk about soybeans.
Okay, so on the soybean outlook side, of course, not a tremendous amount of change on the net. When you net everything out this last month, we had crop area revised down just a little bit for 2019, but then you had yields increase. So all in all, they found a few more bushels of soybeans. It's only 0.2%, but a little bit of a production upswing. USDA did not include any impacts from the phase 1 trade agreement yet. Now, on the other hand, though, FAPRI did factor those into the 2020 projections that are on the column to the right. So keep in mind that 1.9 billion bushels that they're projecting for exports in 2020 does factor in at least an initial impression of the trade agreement. And of course, that may get revised as we find out more and more details. If you look at the soybean price, and I'm going to jump back to 2019-20, it is projected at $9. You notice last month we had revised it down to $8.85, and the previous month, back in November, it was $9. So it's kind of bouncing around here a little bit, but it's sitting at $9. FAPRI slightly higher than that, based upon factoring in the trade 1 agreement. It's it's closer to 907 or 908. Then if you look at where we're sitting for exports in 2020/21, at 1.9 billion bushels that FAPRI has in there is largely working. When you look at the difference in ending stocks year to year, is not much change. And so it's really those exports, those additional exports, that are helping to offset the recovery in production, mostly due to planted area. And so hopefully in 2020, we don't have the same experience with prevented plantings and whatnot. So at least that production increase is partially being absorbed by the increase in exports. So if we go on to looking at how soybean exports have been doing this year, it's kind of interesting. We are sitting, now at probably about the same level as we were last year. If you look, last year the data looks like it flattened out. That's because, remember, the government closure at this time last year. So hopefully, as we look at this year's data we'll continue to see those dots fill in that gap, and we'll continue to see an expansion in sales year to date. And if we look at outstanding sales to China, apologize, I clicked once too much. You can see we're running well ahead of last year's pace, and that's good news. We hope that's going to continue or even potentially accelerate after tomorrow's announcement. But one of the things to keep in mind is usually about middle of February, a lot of the sales to China switch over to Brazil. So it'll be interesting to see if that dynamic is affected by the new phase one trade agreement. Year to date accumulated sales. So we are sitting at 400 million bushels, from September 1st to January 2nd. So that's considerably better than last year. But notice that back in 2017 marketing year, we would have already been at 900 million bushels. So we're not, we're still not anywhere close to the pace we were a couple of years ago. You'll also notice that there's a few other countries where we've got some declines. Part of it is a better canola crop in the EU has resulted in them not having to import as many soybeans. You can also see that Mexico isn't importing quite as much, at least at this time, relative to last year. Sometimes that can change. Then I wanted to just kind of give you an update on Brazilian soybean production. Actually, the growing conditions in Mato Grosso, one of the largest producing regions or the largest producing state at 29% of Brazilian production, is in excellent shape. Really there's only a few areas of stress. And if you look down here, Rio Grande do Sul, and then if a little bit up here in the northern region, those two areas are having a little bit of dry conditions, and you'll see that better on this map. You can see the areas that are circled here. And so that's really the only couple of spots that are experiencing some issues. Now, it is important, I'm going to jump back here, but it is important to remember that Rio Grande do Sul is 16% of Brazil's production. So it is a significant portion of the production. So we'll see how that all works out. But USDA said, hey, this month we're not going to revise any of the production estimates because I think partially the Mato Grosso region looks so good that they are reluctant to make a change in the estimates at this time. So if we look, really the only change in the SNUs in January was a change in feed residual use in Brazil. Not much else. That was just translated into ending stocks. So really not a lot of excitement on the South American soybean supply and use side. If we look at January 2020 soybean futures, last few days and even week, we've been trading largely sideways. After the announcement about the trade agreement, we've got some upward momentum. Tomorrow will be an interesting day to see if we do get either a lot stronger upward movement or even potentially, the opposite way if things aren't what folks are expecting. But hopefully there'll be a little bit more details, and we will actually see the market find some strength out of what we learn tomorrow about the trade agreement. So in general, not much change in January estimates as we look across the world. The big perhaps news down in Brazil is, Mato Grosso has excellent growing conditions. And so the crop appears to be in very good shape. Lots of uncertainty about that phase one trade agreement. And so we're watching that very, very closely to see if there's going to be pricing opportunities show up. So with that, I'm going to turn it over to Dave and let him take you through the technicals. So. Dave, I'm not able to hear you, Dave.
Now, can you hear me? When I can you give me control again,
Yes.
Maybe y'all can hear
Yes.
me now.
Yeah, I can hear you right now.
I think when I gave me control, I lost it. I lost it. Okay. Let me see if I can move it. I guess I need to control. Can you give me control? Or maybe you have. Okay, I got it now. Okay. Yeah, I think I can't, in some ways, can't really add a whole lot of what's been sort of said so far. I think everybody's looking for the last several months. Everybody was looking at the January USDA report as sort of the big report, and I think it was sort of a dud a little bit. I think it didn't really give them the big numbers. Well, I guess maybe I should say smaller numbers than expected in both acres and yield. So I guess tomorrow will be the big report, and we'll see what happens. But I guess I'm going to be a little optimistic that maybe we've turned the corner on this a little bit and maybe got some better, at least potential demand going forward. But in the short term, it's sort of been alluded to already, I think in a lot of the charts you've already seen, that we're just really at sort of a sideways trading range. You sort of look at that March 2020 chart, corner, you look sort of the upper left hand corner, you can see where we were at just back in the summer and some of the potential prices we had, and now look where we're at now. And I'll sort of point it out here in a minute. I think usually anytime we get any of our futures prices in the fours, wherever you want to put it at, low fours, mid fours, I think a farmer has to take advantage of that and make some sales. I think that's how it goes. If you don't like the basis, at least lock in the futures or whatever. And it looks like to me that 410, and if you look at it from a technical standpoint, that little blue line, I believe that's a 200-day moving average. And again, I always say, what makes technical analysis work? Well, technicians make it work, and that's basically what's happening there. But I think we're just sort of in that trading range. On the day of the report, you can see we're down pretty hard. They call that sort of a doji hammer a little bit. Maybe we call it maybe hammering out a low right there. We'll see. But again, tomorrow, all this won't mean a whole lot. If the report's negative, maybe they delay it or doesn't come out what everybody will expect, or the old buy rumor sell the fact. It may try to test the low. But I would say this: if you get March corn, if you're holding much old crop corn and get back up in the fours again, you probably need to take advantage of that or anything close to it, because that we're just in that trading. We're going to need something bullish sort of break us out of that right now. I think already been mentioned a while ago. In the near term is what kind of corn crop they're going to have in South America, which they're just going to start planting here. It looks like the soybean crop really looks good down there. And so, but then again, so it means that hopefully if they get the bean crop off in a decent time, they'll get the corn planted. And if they do, and it looks good, that's going to put a lot of pressure, I think, on corn prices. The big thing I keep looking at, again, just repeating what's already been said, is how much bushels of corn are still sitting out in the Dakotas and what kind of quality that is. And that could really have a big impact that I think was alluded to earlier, what kind of stocks we're going to have, maybe in that third quarter, maybe the March stock report, the June stock report, we could have a big drop there. And again, it may have a big rally in future. So I say if a farmer take advantage of this, especially the basis, if you want to hold a few bushels for gambling bushels, I guess, or some bushels just in case they have a big bullish report going forward, I think I'd take advantage of that. This is July, not March, but I like to look at the weekly charts. It gives me sort of a trend, and I keep repeating myself. I don't have anything new to say. I still say since about 2015, around 14, October 14th, we put in sort of a low, and we're just in a big trading range, especially in corn. I mean, it looks pretty obvious. Anything on that July chart, anything above $4 or $4.20, it's definitely a selling opportunity. Now, we had probably more of an extended time this summer just due to all the weather uncertainty. But normally you can see once you get much above 420, it doesn't last more than just a couple of few weeks, and it just drops off like a rock. And because why? One of the biggest drivers I keep thinking come back to is weather. Weather impacts planted acres, harvested acres, and yield. And you can look at about 360 is usually our low. So I'd say right now we're trying to hang on to that about what 385, 390. But if we get it any kind of that going into the late spring into early summer, if you're pushing it anywhere close to that $4 range, I'd probably be a seller if you have any corn left over. The next chart is December, sort of the same scenario there. I don't, again, we've rallied up to about that 408, 412 level. And again, a big old hammer after that after that January report. Now we'll probably wait and see what happens tomorrow. If it's sort of bullish, we may run up. Who knows? May run up there and try and come back. You never know. But anytime you get December corn futures, anytime above that $4 level, you probably want to sell a little bit. That's probably not a bad idea, and that's probably shown this next one. And this is a graph that I like to show. Again, sort of shows the same thing. About 360. Excuse me. I can't hardly see that very well here. You're talking about about 360 December, 420 on the upper end. Anytime you hit those levels, you probably want to be a 420. You want to be a seller of it, and so take advantage of that. Because again, I still think we're just sort of in a trading range. The market goes below that 360, especially if a lot of supply or maybe some demand names not too good. And there's soybeans. Again, we're sort of marching right back up to that high again from back in the fall, and we'll sort of see what happens there. We've had a pretty good basis here in Southeast Missouri in both corn and beans, and I'm trying to tell guys might take advantage of that and go ahead and make some sales. If you look at again, there's the weekly July. I think a lot of that difference we see in price there to that top line is probably those MFP payments probably made up the difference. What's happening in China, I think John showed the several hundred millions of bushels of exports we've sort of lost to China last year, and hopefully now we can start making some of that back up. So we kind of rally, we get back in that 1060. But you can see over the last few years we've had about a $2 trading range. So again, I tell guys, anytime you get bean prices anywhere close to $10, you need to take advantage of that right now. Especially we're looking at a pretty good soybean crop down in South America. That's definitely putting some pressure on the crop. Maybe not immediately, but here soon. And there's a November. And there you go. There's November just knocking at the door at the high from this past fall. And again, probably not a bad idea. Maybe reward the market just a little bit. At least start, if you hadn't made some sales, at least try to make a few little sales there, because it's sure not a bad idea. And again, so that same scenario I mentioned a while ago, anytime you get new crop up in that upper $10 level, you need to make a sale. The reason, again, I think probably didn't get that high was, those MFP payments sort of buffered it, and that was due to what's happened to trade with China. The only one that's really chart that actually looks sort of bullish, I guess, is just wheat, and it just keeps marching on higher, doesn't it? Any stocks are starting to drop a little bit, still quite a bit. I think they've had some problems over in I think Australia and places like that, but we're going to see here that if you look at the wheat weekly chart, we're definitely right at the top. So anytime you get wheat price, that's a continuation. These are the continuation charts of both the July wheat and the December corn and November soybeans. Anytime you get those wheat prices up in that upper fives, close to 6, you probably need to sell some new crop. And we've been having some pretty good basis down here, so I know guys will start taking advantage of that. I'd also say, warn this guys, normally, the markets are sort of rallying a little earlier than normal, making their like possibly hitting some of the highs, possibly a little early. And it's not unusual in years where it's perceived that made the markets a little bit short of a crop. I'm not saying this year is necessarily that way, but I think just due to what's happened to the weather and what's happened this year. So, and I think a lot of like you said, these prevented plant acres get planted back, especially in corn. There's been some big numbers thrown out there. Corn acres could get planted. So I would again, anytime you get beans get back in 10, anytime corn gets over 4, anytime your wheat gets up in that upper 5, you hit 6, you better take advantage of that. I think that's those some opportunities. So do I need to give it back, John? So yeah, give it the remote. There you go.
All right. Can you guys hear me okay, John?
Good.
All right. Well, let's look at the livestock outlook real quick. I know we wanted to leave some time for questions, so I'm going to try to go through this pretty quickly, but the story really hasn't changed from the previous months when we've been doing this discussion. If you look for almost a decade, our total meat production, being beef, pork, and chicken added up together, had basically been trading, in a range of about 2 billion pounds from year to year over that entire decade. You go into about 2014, suddenly we went up 2 billion pounds and have went up basically for the last 6 years. The last line there going from 2019 to 2020 actually is a 3 billion pound increase, even a little bit more. This is one of those slides that economists love to look at, and I know it takes a little bit of time to digest. It's kind of busy, but if you have time to go back and look at this later, there's a lot in this. The red bars are the increase in production for the different commodities in the different time period. The blue bar is the increase in net exports, and the green bar is the increase then left over that has to be eaten by domestic consumers, domestic use. And so if you look at, for instance, the first block there, beef, 2017 to 2014, had a dramatic increase in production, not much increase in exports, but a pretty, leaving a huge increase for domestic use. Now moving to the second group in 2020 to 2017, not quite as much increase in production, a little bigger increase in exports, and so not quite as much increase necessary for domestic use because we exported some. But if you jump to those last two sets of 3 bars and look at chicken, look at how big that red bar is in both 2017 to 14 and 2020 to 17. Huge increases in the red bar in production. Not much change, even a negative change in the first set in exports, but a huge increase there then carrying over for the domestic use. And that's something I'm going to come back to a little bit later, is this tremendous increase in chicken production that is going to be affecting our total meat supplies. So, how much meat is too much meat? So if you take that increase in production, you take out the net exports, that is what is left over for U.S. consumers to eat. And so we're now well above, about 206 pounds that every one of us has to eat of total meat. And that is more meat than we have had to eat for each of us all the way back to 1980. The good news, the really good news, is that if we were going to have this tremendous run up in meat production, at least it occurred at a time when we are at full employment and the economy is doing well, so that people have the money, disposable income, to be able to afford to buy meat. And they've decided demand has improved, and they've decided they like eating meat again. Can you imagine if this increase in meat production had occurred at a time when we had high unemployment? Because go back to Economics 101, if you've got more of something, to get people to eat more of it, generally you have to lower the price. Well, thankfully, we haven't had to do that in this case, and the strong economy is a big driver in that. But the question still holds: how much is too much, and at what point will they begin to back off? So if you do look at the January WASDE numbers, what they've come out with, if you look at that total production there, in 2019, we had about 104.8 billion pounds of total meat produced. It's going to go up to 107.8 in 2020. Exports go up, that down there, the second row of blue numbers go up about 1.4. But what does that mean again for domestic use is almost 2 additional pounds of domestic availability that we have to eat, throw away, or do something with. So if I back up again to that production number just a little bit to think about this, 3 billion more pounds again on top of those last 5 to 6 years that we've increased 2 billion more pounds. I mean, that's the story we've been telling for the last several years. It's just more and more production. Can we continue to eat our way through this? And when I was preparing for this, I thought, every month that 2020 forecast has increased. So I went back just to look, for instance, how much it had. And back in July when we did this talk, that total production estimate for 2020 was 2.5 billion pounds less. So just in a little over 6 months, we have increased what we think we're going to produce next year, or this year now, 2020, by 2.5 billion pounds alone. And it's interesting to look at what those are. Beef was still exactly what it was in July, 27.5 billion pounds. Pork was up 500 million pounds from where it was in July, but chicken had increased 2 billion pounds. So again, one of the things we're talking a lot about ASF and what that means for the meat markets. One of the stories that's not being told is this increase in chicken production, and what is that going to have on our total meat consumption. So looking at prices again, John's already told the story about ASF and what that's going to mean or could mean for hog prices. Hopefully that is going to mean some short-term strength, but the concerning thing is it hasn't necessarily come to fruition like pork producers thought it was going to. Back looking at that July WASDE number, at that time we were forecasting 60 cents a pound for barrel and gilt prices in 2020. That's now lowered to 54.50. If this trade deal comes through great and China starts buying a lot of pork, yeah, that could quickly jump back up to that 60. But the tale of two stories as well. If the purchases don't come through, that number right there, that 54.50 on pork, could very well be overseen. On the Fed steer, for USDA's forecast on 117.50 for 2020, that may even be a little bit conservative. We still are suffering some of the effects from the plant closure, from the fire. I think generally most market analysts are thinking we're working through that, and hopefully now prices maybe are cautiously optimistic that beef prices could go even higher than what USDA is forecasting at this point. The other good news for the beef industry is beef cow slaughter is at an all-time high there, looking at the number of cows we're slaughtering. The concern is that's what the data is showing. I've talked to a lot of producers in Missouri that based on prices, what cull cow prices were and stuff, that they're just holding on to those girls a little bit longer. So my question is, this is what the data shows, and I hope the data is right, but anecdotally, I just hope this is true, because a lot of people I talk to are still holding on to them. And so if the beef cow slaughter really is this high, which the data would indicate it is, hopefully that means herd expansion is done, and we can look at this January estimate to come out and maybe have a few less cows going forward. Slaughter steer prices have finally recovered from that big dip back there after the Kansas plant fire, and have trailing back with last year's prices. Calf prices, however, just really struggled. That dark blue line is 2019. The dotted line is 2018. After that fire, it has really thrown the calf markets kind of in upheaval, and they've really struggled to get back to prior year prices. We had some strength there at the end of the year, and thankfully here in January we've started off to a good start. Barrel and gilt prices again just unfortunately aren't coming to fruition, that tremendous increase that we thought. Let's hope this trade deal is going to change that and those prices will increase. Weekly pork shipments to China have increased in spite of the increased tariffs. Hopefully this will continue to get even better. If you look at that WASDE projections again for 2020, the red line is the Fed steer, the blue line is the barrel and gilt prices. Again, thankfully, that red line is turning up for fed steer prices, and hopefully that's going to continue to increase, and we're looking at stronger prices in 2020. The blue line, however, the barrel and gilt prices, as I said, just haven't come through like we thought they would. Let's hope this trade deal changes that, and we can get back to what even as little as 4 or 5 months ago, what we thought that was going to mean for our pork producers. Dairy prices have had some strength there at the end of the year, and forecasting a slightly higher price for 2020. I think I got through, John, just barely. Looks like it's 2 o'clock. I don't know if you've still got some time for questions or not, but I'll turn it back to you.
Okay. Yeah, we certainly do have some time for questions. I also wanted to draw your attention here. You know, we have these set up now for the next 6 months. They're mostly at 1 o'clock, with the exception of February, which is scheduled for 3 p.m. due to some other meeting conflicts that we had here. But we hope you'll join us for those. And with that, let me go over and ask if there are any questions that anyone has.